Hello, everyone. A huge, warm welcome to you all. Thank you so much for coming to watch the video today.
Great to be here.
We really appreciate you spending your time with us. It's February 2026 already, and today we are turning our attention to Lyft.
And this is a big one. It feels like a real pivot point for them.
It does. They've just dropped their numbers for Q4 and the full year of 2025. And, these calls can be a bit dry.
Oh, for sure.
But this one feels different. It feels like they're trying to answer a huge question about their future, especially with, automation changing everything.
It really does. So to keep this organized for you, we're going to break this down into two parts. First, we'll hit the prepared remarks from the CEO, David Risher, and CFO, Aaron Brewer.
Get the big picture first.
Exactly. The headlines, the vision. Then we're going to do a detailed run-through of the Q&A with the analysts.
That's always where the real story is, right? The prepared remarks are the polish, but the Q&A is where the rubber meets the road.
That's it. We'll go question by question to see what Wall Street is worried about and how Lyft is pushing back.
Okay, so let's start with those headlines. Risher and Brewer came out swinging. They reported that gross bookings for Q4 grew 19% year over year.
Which is a big number. For a company people were calling stagnant a few years ago, 19% is serious acceleration.
It really is, and the volume backs it up. For the full year, 2025, they had 51.3 million riders.
And they took, almost 1 billion rides?
946 million rides, nearly 1 billion. It's staggering.
It is.
And David Risher dropped this little fun fact that stuck with me. He said that in the time it takes to say one sentence, something like 400 rides started.
Wow.
Yeah, it breaks down to about 30 rides starting every single second. Just tick, 30 cars, tick, another 30. It's a wild visual.
It's a great way to frame the scale of it. But beyond volume, we have to talk about financial health. That was a huge theme.
Right. The old knock on rideshare was great growth, terrible business.
Exactly.
Yeah.
But they hit record profitability this year, generated over $1 billion in cash.
Which sends a very strong signal. The cash burn days are over.
Precisely. And they're not slowing down. They're tracking toward their 2027 goals.
Yeah.
$25 billion in gross bookings, a 4% adjusted EBITDA margin, and, again, over $1 billion in free cash flow every year.
So making money and growing. But I like how they're framing how they're growing. They keep using this phrase, customer obsession. And, I usually roll my eyes at that kind of corporate speak, but they seem to be backing it up with actual products.
They are. The best example they gave was Lyft Teen.
Right. This is huge. You've got 40 million teens in the U.S. who are either locked out of the market or, using it against the rules.
It's a massive demographic to unlock. And it solves a real problem for parents, too.
Absolutely. And speaking of solving problems, they cited this independent study that riders save around $177 a year just by checking both apps before they book.
Smart. They're positioning themselves as the value option.
Yeah, they're basically saying, hey, we know you have the other app. Just open ours, check the price. You might save some cash.
It's a good play in a duopoly. Now, before we hit the Q&A, there were some strategic updates. A little changing of the guard, Aurélien Knopf is leaving, and Aaron Rome is stepping up as the new head of investor relations.
Okay.
But the bigger headline, and this really sets the stage, is how they see the future. They're putting Lyft right in the center of the AV revolution while also expanding into Europe and chauffeuring.
A lot of moving pieces.
Yeah.
Okay, let's get into the weeds, my favorite part. We're going through the Q&A question by question because the analysts did not let them off easy.
Let's do it.
All right, question 1, Eric Sheridan from Goldman Sachs. He asked a big picture question, basically. What worked last year with product and volume, and how does that set up your priorities for the next 12 months?
Yeah, he was asking for the secret sauce. And this is a great setup for David Risher to explain their philosophy. He went right back to customer obsession, but he framed it around the total addressable market, or TAM.
Right, he talked about the 95%. Break that down.
So Risher's point is that the total transportation market is something like 300 billion rides a year in the U.S.
Okay.
Lyft and its competitors, they only handle a tiny fraction of that. So Risher says they're focused on the 95% of the market they don't have yet.
So he's saying, I'm not trying to steal a customer from Uber. I'm trying to steal a customer from their own personal car.
Exactly. It's not a cage match. It's a land grab. And he pointed to partnerships as a key driver, called out DoorDash as their most successful ever.
That makes sense. Same demographic, really.
And the new United Airlines partnership. Riders have already earned 115 million miles. That creates a really sticky ecosystem.
Sure does. He also mentioned Lyft ads, right?
He did. It's at a $100 million run rate now. It's a serious new revenue stream. And then he touched on AVs, saying, while they won't be financially material in 2026, they're going to expand that TAM even further.
Okay, on to question 2. This was from Doug Anthon at JP Morgan. He got into the numbers. He asked about Q1 margin guidance, but then he got really specific on flex drive.
Yeah, he wanted to know about this 20% cost efficiency claim they have.
Right. And this is where we got a deep dive into the economics of what they call the hybrid network.
Erin Brewer took the finance part first. She said Q1 growth is fueled by a healthy marketplace and high-value rides. She also warned that year-over-year margin comps are tricky because of a one-time item last year.
Okay, but talk to me about this hybrid network idea. Why is it so important? Why can't we just have robo-taxis everywhere tomorrow?
This is maybe the most important point they made. David Risher was very clear. You cannot just run a network with only autonomous vehicles.
Why not?
Because demand swings wildly. He cited a 20-to-1 swing between rush hour and, say, 3 in the morning.
20 to 1, wow. So you need 20 times more cars at 5 p.m. than at 3 a.m.
Correct. And if you own a fleet of very expensive robots, you can't afford to have 95% of them sitting idle for most of the day. It's financial suicide. You need human drivers, gig workers with their own cars to handle those massive peaks. That's the hybrid model.
So the robots handle the steady base load, and the humans flex up for rush hour. That makes a ton of sense.
Exactly. And cost-wise, they see AVs lowering costs by about 20% by 2030, mostly from insurance savings. But the kicker with FlexDrive is that they think their software can squeeze even more out of it, getting that efficiency up to maybe 24 or 25%.
A huge competitive moat if they can pull it off. Okay, question 3 from John Blackledge at TD Cowen. He asked if they're basically buying growth with discounts. Is this growth fake?
The eternal question. But David Risher was firm. He called Lyft a disciplined operator. He admitted competitors threw out some promo gimmicks in Q4, but insisted they stayed focused.
And he had that great Super Bowl stat to prove it.
Oh yeah, that was great. He said compared to last year's Super Bowl, Lyft did 15% more rides.
With 20% lower surge pricing. That's counterintuitive.
It is, unless your marketplace is just that much more efficient. That's operational excellence. Better service, lower price, without burning cash.
Impressive. And Erin Brewer added that active riders grew 18%, a record.
Right, and for Q1, they expect gross bookings to grow faster than ride counts, which points to more of those high-value trips.
Got it. Okay. Question 4. Chad Larkin from Oppenheimer asked about taxes. This surprised me. I thought taxis were the enemy.
It's where the Europe strategy comes in. Risher called taxis a supply lever. They're using them in a few U.S. cities now, but the real context is the FreeNow acquisition.
Right, the European company.
Exactly. In Europe, taxis are dominant and regulated. FreeNow has deep expertise there, and Lyft is now using that expertise globally. Brewer said FreeNow's on track for a €1 billion exit rate in 2026.
So it's not a side project, it's a serious part of the business.
Not at all.
Okay, question 5 from Nikhil Devnavi at Bernstein. He asked about hitting those 2027 margin goals, and then he asked the elephant in the room question. How do you handle markets with intense AV competition, like the Bay Area?
Basically, is Waymo eating your lunch in San Francisco?
Yes.
On margins, he's stuck to the fundamentals. Operational excellence, fewer incentives needed, partnerships bring in higher spending riders.
But what about the robot competition? I see those Waymo cars everywhere out there.
Risher was candid. He said AVs are still a premium product. So Lyft competes on service. A robot can't help you with your luggage.
That's a good point.
And they offer things like wait and save. Plus, and this was the killer stat, he said, in San Francisco, probably the most competitive AV market in the world, Lyft is growing at about 10%.
Growing 10% in the face of fully autonomous competition. That's a huge validation of the hybrid model.
It is. It proves the market's expanding, not just shifting chairs.
Okay, question 6. Ben Black from Deutsche Bank. He asked about California demand after the insurance changes and about loyalty programs.
Right. The California insurance reform went into effect January 1st. It lowers premiums. Lyft is passing those savings to riders.
So prices are lower.
But he said because Q1 is seasonally slow, the actual demand uplift from that probably won't show up until the second half of the year. It's a lagging indicator.
And loyalty. Are people sticking around?
The numbers look strong. He claimed a 31-point advantage in driver preference over competitors.
31 points is a massive gap.
It is. And on the rider side, business travel activations are up 26%, and they're testing a Lyft Cash Rewards program. It's all about that ecosystem lock-in.
Makes sense. Question 7 was from Michael Morton at MoffettNathanson, a pointed one. He asked why there aren't new AV partners. Is there friction in the Waymo deal?
Yeah, basically asking, why aren't you announcing a new robot partner every week? Risher pushed back hard. He said their strategy is deliberate depth with partners like Waymo and May Mobility because, honestly, very few can operate safely at scale right now.
That's a reality check. There aren't dozens of companies ready to go.
Not at all. It's a supply constraint, not an economic fight. And Aaron Brewer cleared up the take rate question. There was a one-time $210 million legal reserve hit. Without that, margins look normal, an accounting thing, not a business trend.
Good clarification. Okay, almost there. Question 8 from Ross Sandler at Barclays about FlexDrive locations. Does he have to spend a ton to retrofit them for AVs?
It's an infrastructure question. The answer was evolution, not revolution. Existing facilities work for now. New sites, like in Nashville, are purpose-built for AVs. They'll layer the new stuff on top of the old.
Smart. Don't spend the money before you have to. And finally, question 9 from Justin Post at Bank of America about the U.S. AV supply pipeline out to 2030.
Yeah, Risher zoomed way out for this one. He called it a $1 trillion opportunity.
Wow.
He pointed to all the capital flooding in from NVIDIA, Rivian, Mobileye.
The big guns.
The big guns. And he ended with this idea of waves. You've got the first wave, leaders like Waymo, then you'll get fast followers. He believes there will be multiple winners, and Lyft wants to be the platform that aggregates them all.
A fascinating look at the future. Okay, we've run through the numbers, the strategy, the grilling. Let's wrap this up. What are the big takeaways?
I'd say there are 3. First is operational discipline. They're not just chasing growth. Record profitability, strong guidance. They're running a tight ship.
Exactly what the market wants to see. And second...
Second is the hybrid network. They are all in on this idea that humans plus AVs is the winning formula. It lets them handle those crazy 20-to-1 demand peaks that robots alone just can't.
Right.
And third is that customer obsession thing. It sounds like a cliche, but when you see the partnerships, the Lyft Teen product, they're finding ways to be useful in specific moments of people's lives. That's organic growth.
And I think that leads to a really interesting final thought for people. We talk about tech companies as disruptors, but Lyft seems to be positioning itself as the great stabilizer in this transition.
Oh, that's a good way to put it.
Yeah, they're basically saying, we'll keep drivers earning, we'll bring on the robots when they're ready, and we will make sure you get where you're going no matter who or what is driving.
That's the long-term view. They're not just a ride-hailing app. They're positioning themselves as this essential partner in the autonomous transition. It's a very smart place to be.
Well, that brings us to the end of our deep dive into Lyft's 2025. Thank you all so much for watching. We hope this breakdown gave you some clarity.
Yeah, it was a pleasure to break it all down.
If you like this video, please go ahead and click like, share it with your network, subscribe to the channel, and stay tuned for our upcoming content. We'll see you next time.